Have you ever wondered what keeps a company's financial records honest and accurate? It's not magic. It's a simple but incredibly powerful rule at the heart of all bookkeeping. It's called the accounting equation. And once you understand it, you'll see your business finances in a whole new light. So what is this magic formula? It's simply this: assets equals liabilities plus owner's equity. That's it. This single sentence is the foundation of every bookkeeping system in the world. It ensures that for every transaction, the books remain perfectly balanced. If one side of the equation changes, the other side must change by the exact same amount. This fundamental balance is what makes the entire system of double-entry bookkeeping work. Let's break it down piece by piece. First up, assets. Think of assets as everything your business owns or controls that will bring it a future economic benefit. This includes the cash in your bank account, the money your customers owe you, known as accounts receivable, your inventory waiting to be sold, the equipment you use to get the job done, and even prepaid expenses like insurance. When your assets increase, it means your business has gained more resources. When they decrease, it means you've used or sold some of those resources. Next, we have liabilities. This is the other side of the coin. Liabilities represent what your business owes to others. These are your financial obligations. Common examples include loans from a bank, bills you need to pay to suppliers, which are called accounts payable, balances on your company credit cards, and of course, the taxes you owe to the government. Liabilities are essentially promises to pay someone in the future. Finally, there's owner's equity. This is what truly belongs to the owner. It represents the owner's so'ness claim on the business assets after all the liabilities have been paid off. You can think of it as the net worth of the business. It's calculated as assets minus liabilities. Owner's equity is made up of the initial money the owner invested, any profits the business has retained over time, and it's reduced by any money the owner takes out for personal use, which are called withdrawals or draws. So, how do these three parts fit together on your financial statements? Imagine a balance sheet. It's called a balance sheet for a reason. On the left side, you list all of the company's assets. On the right side, you list all of its liabilities and the owner's equity. And here's the rule. The total of the left side must always equal the total of the right side. When it balances, you can be confident that your books are in order. If it doesn't balance, it's a red flag. It tells you there's a mistake somewhere. Maybe a transaction was missed, an amount was entered incorrectly, or something was duplicated. Now, let's see how this equation works in your day-to-day bookkeeping with some real-world examples. Imagine you're starting a new business and you invest $10,000 of your own money. What happens? The business is cash, which is an asset. Okay? Now your business needs a new computer. You buy one for $2,000 using cash. In this case, your equipment, which is an asset. What if you need more cash and decide to take out a $5,000 loan from the bank? Your cash, an asset, increases by $5,000. But now you have a new loan, which is a liability. Your liabilities also increased by $5,000. Assets went up and liabilities went up. Balanced again. You see the pattern? Every single transaction affects at least two accounts, keeping the equation in a state of perfect equilibrium. This is the essence of double-entry accounting. The terms you've probably heard, debits and credits, are simply the tools we use to track these changes and maintain the balance. As a general rule, assets, expenses, and owner draws have debit balances, while liabilities, equity, and revenues have credit balances. For every transaction, the total debits must equal the total credits. This strict equality is what protects the integrity of the accounting equation. We can even expand the equation to make it even more useful. Remember, owner's equity changes over time based on business performance. So we can expand it like this. Assets equals liabilities plus your beginning equity plus all your revenues, minus all your expenses, and minus any draws the owner takes. Revenues, like sales, increase your equity because they generate profit. Expenses, like rent and salaries, and owner draws decrease your equity. This expanded version beautifully shows how your income statement, which tracks revenues and expenses, directly connects to your balance sheet. At the end of every accounting period, the net income or loss from your income statement flows into the owner's equity section of your balance sheet. That's how these two critical financial statements are tied together. So when you're doing your bookkeeping, I want you to start thinking like this. You're not just entering numbers into a spreadsheet or software. You are a guardian of the balance. Every invoice you send, every bill you pay, every loan payment you make, each one must fit perfectly into the accounting equation. This mindset is what ensures your financial records are 100% accurate throughout the entire bookkeeping cycle, from recording journal entries to posting in the general ledger, to creating a trial balance, and finally, preparing the financial statements. The accounting equation is your constant checkpoint. If your total debits don't equal your total credits in the trial balance, you know the equation is broken somewhere. If your final balance sheet doesn't balance, something has been misclassified or missed. The equation is your guide to finding and fixing those errors. What are some common mistakes that throw the equation out of balance? A classic one is entering only one side of a transaction. For example, recording a cash payment but forgetting to record what the payment was for. Another is entering a different amount on each side of the transaction. Or maybe classifying an owner's investment as revenue. That's a big one. Each of these errors will cause your books to fall out of balance, but by constantly checking against the accounting equation, you can catch them quickly. So let's do a quick recap. The accounting equation is assets, balance liabilities, plus owner's equity. Assets are what you own, liabilities are what you owe, and owner's equity is the owner's stake in the company after all debts are settled. Every single business transaction affects at least two accounts, and the equation must remain in balance every single time. This principle is the backbone of double-entry bookkeeping and links all your financial statements together, ensuring their accuracy. When you truly grasp this concept, you gain complete control and confidence in your financial records. You'll be able to trace any number on your balance sheet all the way back to its original transaction. You can clearly explain to anyone, a partner, an investor, or a bank, why your financials are structured the way they are. Most importantly, you can guarantee that every report you generate is accurate, reliable, and trustworthy. That is the incredible power of the accounting equation. It is the very heartbeat of bookkeeping and the foundation of every successful business. I hope this deep dive into the accounting equation has been helpful for you. If you found value in this video, please give it a thumbs up. And don't forget to subscribe to the channel for more tips to help you master your business finances. Thank you for watching, and I'll see you in the next video.